All right. Well, Corey Martin, welcome to the Brooklyn Boardroom, brother. It's been a long time. Good to see you. Yeah, I appreciate you making the time. I know how busy things are these days in the wake of the COVID epidemic and just life in general. But listen, Corey, do us a favor for the audience that doesn't know you, which probably most people don't, because we tend to be behind the scenes as lawyers.
Right.
Tell a little bit about, what kind of work you do, where you do it, and how you got into the role you're in today.
Absolutely. That's great. And again, thanks for having me. Great to be here. Good to see you. So my name is Corey Martin, and I'm the managing partner of Granderson de Rochers LLP, which is a boutique entertainment and media focused law firm with offices in New York City and also in Beverly Hills. In addition to being a managing partner of the firm, I'm also the chairman of our corporate department. And in that capacity, I support my colleagues as well as my organic clients in any sort of corporate transactional matters, mergers and acquisitions matters, corporate finance or investment activities. Our firm is really unique in the sense that at our core, we're really about talent representation. So whether representing actors, actresses, directors, and producers on the film and TV side, representing writers, recording artists, and producers on the music side, our DNA is really about representing talent, getting them the best deals, doing landmark deals, and really empowering our talent clients to realize their full potential, both in their chosen endeavor, but also helping them prepare for life after they're no longer in front of the screen, no longer in the recording studio or on stage, but helping them transition into entrepreneurs. And from my perspective, that's the part of my job that's most exciting, helping our talent clients transition into being entrepreneurs. Everyone wants to be the next Jay-Z, the next Diddy, the next Dr. Dre, but it's easier said than done. It really takes a village and a team of seasoned, experienced professionals to help them get to that stage. And that's what we really take pride in being able to do with our clients. And as to your specific question in terms of how I got to—
Before you get to that, I just want to just take a little moment here and add a footnote for context. I didn't think about this, but just give us some general range, like the ranges of financing you deal in for your clients, so people understand the depth and width and degree you're in the capital market space.
Absolutely. I mean, look, it really runs the gamut. It could be a client that comes in that wants to start a company from scratch. They have an idea or a concept that they want to pursue. And in those instances, it's more along the lines of aligning them with angel investors, or oftentimes they have friends and family that want to invest in those businesses. And so our role is to help facilitate those investments in a manner that helps the client, the entrepreneur, or the talent, as the case may be, to preserve as much of the equity in that business as they can at that very early stage, while at the same time bringing in the capital that they need to be able to successfully launch their business. Kind of at the next stage of the life cycle is at such time as those clients have launched their business, the business is a going concern, and they're executing on their operating strategy. Oftentimes it's required for them to go out and raise growth capital. And the sorts of investors that they're talking to at that stage could be early stage venture capital firms, could be high net worth individuals or family offices, but notwithstanding the investor profile, the considerations that we take on in terms of vigorously representing our clients are nonetheless the same. We want to make sure that the client is able to raise as much capital as possible, but on favorable terms. The line in the sand that most entrepreneurs really draw is they want to make sure that no matter what happens, until such time as they're ready to exit out of that business, that they maintain control. So whether that's economic control in terms of maintaining a bare minimum of 51% of the business, or if they're set up to have a board of directors ensuring that they control the board and therefore the governance considerations around the business. Those are the items that, for myself and my team, we're keenly focused on in terms of helping to preserve the control that entrepreneurs have in their own businesses. And then ultimately, to the extent the entrepreneur ultimately looks to exit that business, whether in terms of a sale to a strategic or a sale to a private equity firm, we want to, at that stage, make sure that we get the highest possible valuation for the business so that the entrepreneur who's put years and years at that point of blood, sweat, and tears into building a venture, and at any time an entrepreneur is looking to sell, is obviously very personal to them. I'm sure you've dealt with this yourself. From the standpoint of an entrepreneur, selling a business is almost like selling a loved one, selling a baby. So they do it with very careful consideration when they get to that point. But if they are going to go ahead and pursue that course of action, you want to make sure that you get them the most money to reward them for all the energy and effort that they've put in to that point.
Totally. Well, before we take a deep dive into some of the terminology you've used, as well as some of the businesses that you've helped build, liquidate, or manage, for the sake of the audience and listeners, give us a little bit more context on, how you ended up doing the work you're doing, from inspiration to education. Because I think one thing that's really apparent from your credentials, from your presentation, from people that I know that know you, you're well respected, you're well educated, and you know your stuff. So how did this all come about for those who may be listening, wanting to aspire to a similar career path?
It's funny, where I sit today, I've really kind of come full circle in the sense that I went to Howard University School of Law. And while I was in law school, my favorite professor was a guy named Spencer Boyer. And Professor Boyer taught an entertainment law class. He taught a first year contracts law class, which wasn't a lot of fun because he was a tough professor. But by the time you got to entertainment law, he only taught entertainment law to 3L. So it was an elective. It was a fun class. It was my favorite class. And even though I wasn't exactly sure at that point what aspect of law I wanted to pursue, from sitting in his class, I decided I wanted to get into entertainment law. And so I remember having a session with him kind of outside of the class in which I said, I'm really inspired by your entertainment law class. I'd love to pursue entertainment law. What advice would you have for me? And his advice was, if you want to be a great entertainment law lawyer, don't try to get into entertainment law. I was confused. I didn't understand what he was saying. Like, come again? Could you repeat that? Yeah. And he said, you want to make sure that you're the best lawyer that you can be. And once you establish your skill set as a highly proficient, very competent lawyer, then you'll decide what specific area of law you should go into. And that was a really informative and instructive conversation because it really shifted my entire focus. And I understood where he was coming from. I mean, if you're building a house, you want to ensure that the foundation is firm and that there's a solid foundation. And so that really became my focus after I got out of law school and I started my career. So I started working at Sherman & Sterling, which is a large New York-based law firm, on the corporate transactional team with a focus on private equity and mergers and acquisitions. And I worked at Sherman, both in their New York office and their London office for a total of 5 years. And during that time, I just really focused on rolling up my sleeves, learning as much as I possibly could, trying to talk to the senior attorneys, the partners, and just trying to be a sponge. How can I do exactly what Professor Boyer said I need to do? Develop my toolkit, establish myself as a highly proficient, highly competent lawyer, and then whatever would happen down the road would happen. For several years, outside of regularly attending the BISLA conference, which for those of your listeners who don't know is the Black Entertainment and Sports Lawyers Association, they have an annual conference that they've been holding every year for the past 30 years. A great networking opportunity and a great educational opportunity. But for me, other than the one time a year that I would go and attend the BISLA annual conference, the idea of getting into entertainment or media really kind of fell off my radar. We were doing representation for big financial institutions like Citigroup, for industrial companies like Caterpillar, for pharmaceutical companies like Novartis, but entertainment was really the furthest thing from my mind. ultimately, after I left Sherman and Sterling, I ended up at Loeb and Loeb, which is a highly prominent international law firm. And, unlike a lot of similar firms in terms of large multinational law firms, actually had, highly credible entertainment DNA. They had a talent representation practice, they had a music practice, they had a very well-regarded film and TV practice. And even though my focus at that time continued to be mergers and acquisitions, being at Loeb and Loeb, I had the opportunity to work with colleagues and, as I made partners who were involved in high-profile, cutting-edge M&A opportunities, but involving companies that were involved in the media and entertainment space. And so by virtue of that experience, my interest in entertainment was once again piqued. And when I said at the outset, things kind of come full circle, one of the first relationships I made at the BISLA conference, my very first BISLA conference back in 2000, I met a young brother named Damian Granderson, who at the time was still a law student. His path took him directly into the entertainment business, at business and legal affairs, at a highly prominent entertainment firm in New York. And around the time that I made partner at Loeb and Loeb, Damian and I had reconnected, really just as friends, but, kind of sharing thoughts and ideas around career paths. And, ultimately our friendship and ongoing dialogue led me to walk away from being in a big law firm environment where I'd always worked at big law firms for the first 13 years of my career, to ultimately joining Damian in a more boutique environment. And the appeal and the attraction of going into a boutique, to be quite honest, had less to do with the fact that it was an entertainment boutique and had more to do with the fact that it allowed me to work more closely with entrepreneurs and entrepreneurial clients. Because when you're doing work for large corporations, you don't have as much as a vested stake and a vested interest in the outcomes. I mean, you're going to be a vigorous advocate for your clients, respective of the profile of the client, but they're not going to value, a Novartis or a Citigroup or a JP Morgan. That client's not going to value my opinion as much as an entrepreneur who's just starting off, or an entrepreneur who is running a family-owned business, who after 25 years is looking to sell that business. They're going to look to me and my opinion and perspective as it relates to something that's more than likely the most important decision of their lives. So the idea and the opportunity to work with clients in a boutique setting is the reason why I'd originally gone to join Damian at the boutique firm that we worked at that time. And the fact that the firm was focused on entertainment and media was just the cherry on top.
Wow, that's great. Yeah, that makes a lot of sense. I mean, I think you're right about the fact that there's something, as lawyers, we're counselors too, and there's something fulfilling knowing that you're able to provide the support and comfort and expertise and guidance to someone really in need who would be at a loss, but for your presence in their professional life. So that's a rewarding thing. And I totally get what you're saying about that, because I also relish that experience as well. So, all right, well, thanks for sharing.
And look, and I want to add one thing in that regard.
Yeah.
And again, this is not any knocking against big law firms, because as I mentioned, it's an invaluable, for me, it proved to be an invaluable training ground.
Sure.
To be the lawyer I was today, but for that experience. But at the same time, a lot of times when you're in a big law firm environment, you kind of feel as though you're just moving paper from one side of your desk to the other side of your desk. You're just a paper pusher. Whereas at this stage of my career and the work that I'm doing now, I'm much more of an advisor, a counselor, and a consigliere to my clients than someone who's just serving as a scrivener, memorializing deals.
Of course.
Without doubt.
Well said. No, I would agree 100%. All right, well, let's jump into, the meat of this conversation, the corporate finance, M&A. So do me a favor, or do our listeners a favor, for those who may be new to these topics. Let's first just talk a little bit contextually and conceptually about what is M&A, what's private equity, what's corporate finance from the client perspective?
Absolutely. So, and those are all great questions, because 9 times out of 10 with the sort of clients that I deal with, who are oftentimes very brilliant creative minds, but don't necessarily come from a finance background or operational background, we really have to start at square one and lay out all these concepts and explain the pros and cons of pursuing one course of action versus the other. So, starting with M&A, people may hear that term M&A, but don't know what the M is or what the A is.
Yeah.
So M&A is a fancy way of saying mergers and acquisitions, and it very simply involves transactions, which may involve the combination of 2 existing businesses, which is a merger, or the acquisition or the sale of a business, which is the A in M&A, acquisitions. And clients face those sorts of considerations all the time when they reach those fork in the road moments. Do I continue along the path that I have been and continue to grow and scale my business, and therefore either entering to a joint venture or an alignment or a merger may make sense? Or do I look to sell my business to be on the sell side of the acquisition process? That, as I talked earlier about clients facing those moments that are the most important in their professional lives, M&A is something that people don't enter into. M&A transactions are the sorts of transactions people don't enter into lightly, and they do so very carefully, having all the information, and in our role, ensuring that they understand the pros and the cons of the options that they're facing.
Okay. And then private equity?
So what private equity essentially means is private equity investors are a class of investors that represent private capital. So I'll take a step back. Using the word private implies that somewhere in the ether, there's a public. And so public equity relates to companies that are publicly listed. So companies that go out and list themselves on a stock exchange, the New York Stock Exchange, the NASDAQ, here in the United States being the 2 most prominent exchanges. You're listing you're listing your equity for sale in those public markets, and there's a marketplace that allows the buying and the selling of equity in your business. Those are public markets. Conversely, private equity relates to private markets, meaning capital that's not publicly traded, that's not publicly listed, oftentimes capital that may not involve immediate liquidity in the same way that public markets offer immediate liquidity. And from a structural perspective, when people talk about private equity, what they're really talking about are private equity funds. And a private equity fund is a structure which involves 2 parties. You have a manager entity, oftentimes referred to as a general partner, who's involved in managing the business on a day-to-day basis, making investments on behalf of the vehicle, and ultimately being charged with making prudent investments that are going to generate profit that they'll then distribute to their investors. So you have the general partner, or again, the managers, and then you have the investors in those private equity structures. And those folks are often referred to as limited partners. And limited partners are really meant to be passive. So if we had a relationship, you and I was the general partner of the private equity fund, and you were the limited partner in the private equity fund, your role would be, and your primary responsibility would be to write the check and then sit back and, trust in me as the manager of that business to construct a portfolio that would be accretive and return capital to you. If our private equity fund were structured as a limited partnership, which again involves a general partner and at least one limited partner, the limited partners are actually precluded from engaging in the management of the business because they're able to preserve liability. They're able to preserve indemnification really from certain liabilities because of the fact that they take on a more passive role. If you took on a more active role, you would incur or be exposed to potential liability as it related to acts or omissions undertaken by that business. So that's a fairly long-winded way of describing what private equity is and what sort of structures private equity firms normally take on.
This is good. We're gonna give a lot of these terms real context when we throw out some examples, present day examples.
Yeah.
One other area you cover in your work at the firm is corporate finance. So
that's right.
Yeah. How would you describe that?
Yeah. So look, corporate finance involves raising capital, whether in the form of equity or whether in the form of debt, the proceeds of which are used to kind of finance the operations of the business. So oftentimes when you hear companies refers to raising their Series A round of financing or their Series B round of financing and so forth, what they're really talking about is engaging in corporate financing activities that involve soliciting investment from third-party investors, utilizing that investment to fund the operations of your business, and entering into a deal, a pre-agreed contractual arrangement with those investors that contemplates how those investors are going to experience or realize a return on their investment.
Okay, this is great. So just to recap again for the sake of folks who may or may not be able to follow some of these terms in the context,
right.
You know, in the M&A world, when AT&T acquires Time Warner, there you have a merge or an acquisition of a business, and someone with your expertise right. would be the party to kind of guide that process from a legal compliance standpoint or strategic business standpoint, right? And
that's exactly right.
When we're dealing with private equity, that'll come up where, let's say, for example, what was it, Quibi that launched recently. Quibi says, you know what, we'd love to get more money invested into your organization. And there's a there's an investor group or a class that they have relations with, because Quibi, I think, is a private company.
Right.
These guys have 30 million to invest. Why don't we talk to them? You will navigate that transaction, close the deal, do all the filing so that money can be in. And then for corporate finance, I guess I would describe that as kind of like the, quarterbacking, again, for the business, how you deal with raising capital, allocating, risk, and managing the capital raised or debt raised or whatever, right? Would that
exactly right?
Okay, cool.
Hit the nail on the head.
Okay, perfect.
Great examples in every case.
Okay, perfect. Yeah, so I'm doing all right so far. Okay,
doing your thing.
I'm going to get my MBA after this is over. Exactly. Let's jump into some strategic conversation points here. So now the folks listening to this show or watching it would probably be in one of three categories: filmmakers who have projects they want to finance,
right?
Entrepreneurs who have businesses they want to build in the entertainment business. Particularly, I'm thinking like a production company, a streaming service, and then the third category, maybe just the all-inclusive, like, you know what, not sure what I want to do, but I have a laundry list of people that are going to support me with financial capital, and I want to make some. So keeping that in mind,
right?
Let's talk about some of the key things that either of those parties should be thinking about and preparing for if they plan to raise capital in their endeavors.
Absolutely. I mean, look, first and foremost, it's funny, I was actually having a conversation with a new client about this earlier today. Make sure that your house is in order before you engage in any sort of fundraising exercise, whether it be friends and family, whether your targeted investors are venture capital investors or high net worth individuals. Any one of those investors, they don't want to lose their money. Mm-hmm. And given the fact that investors don't go into any investment opportunity looking to lose money, what they're going to do is kind of perform due diligence on you and on your business. And what due diligence means is that they're going to, find out as much about you as a business owner and entrepreneur as they can, find out as much about your business as they can. And to the extent your house is not in order, that's going to be a red flag that more often than not would result in those investors not proceeding with the investment. Now, your house in order, what does that mean? Ensuring that all your filings are up to date. So if you have set up an entity, you can set up a corporation, you set up a limited liability company, you set up a partnership, ensuring that those entities are in good standing. In addition, ensuring that all of your filing fees and your taxes are paid up and are current, because certainly that's the sort of thing that investors are going to want to ensure that, that's in place.
And then bills on time, right?
Yeah. Pay your bills. Yeah. Pay your bills on time. You don't want to have debt collectors chasing after you and have prospective investors finding out about that. And then similarly, making sure that there's adequate paperwork in place before you talk to investors amongst your partnership group. So if you are an entrepreneur and you have, one or two or more partners in your business, ensuring that you have a limited liability company operating agreement. If you're set up as a limited liability company, making sure that you have a partnership agreement. If your business is set up as a partnership, or making sure that you have a shareholders or stockholders agreement to the extent your business is set up as a corporation. I would say that those things, having that documentation in place and readily available and accessible to share with prospective investors once you've entered into a non-disclosure agreement with them, having that documentation in place is absolutely critical, because it shows investors that you're diligent and that you have been focused on dotting all your I's and crossing your T's before you start soliciting third-party investment.
No, really good points. I mean, so you bring up something which was where I was going next with the question, a lot of questioning. So I'm imagining, someone's listening to this and saying to themselves, I'm paying my bills on time. My entity is, I'm paid up in taxes and my annual fees or whatever, registration fees, franchise tax, whatever. They've done all those things. Or they're in another place where they're like, well, I haven't begun to create an entity yet because I'm not really sure how to do that or what to do, because there's so many different variations of entities I create to be the investment vehicle. How would you advise, and I'm going to give you a little bit of a laundry list to work from, but how would you advise if the person has a list in front of them that says, okay, so there's limited partnerships, there's joint venture deals and general partnerships, there are limited liability companies like you mentioned, but there's the managed limited liability company and then the member managed liability company.
Right.
There's C Corps, there's S Corps. So,
long list.
Yeah, long list. So is there a general rule of thumb if the facts are more or less the same, which is a handful of folks when they get together, take on an investment and invest in some entertainment enterprise, whether it be a film property or a streaming service or production company? Is there a general rule of thumb as to how to navigate that with the right entity being created?
Yeah, I mean, look, particularly when in dealing with startup businesses, entrepreneurial businesses, my approach has always been about preserving simplicity until such time as it requires complexity. And by that, I mean, let's set up the most flexible and straightforward form of business to get you into business. Mm-hmm. And 9 times out of 10 for startup businesses and entrepreneurial businesses, that's often a limited liability company. The limited liability company is really a combination of the best features of a partnership, meaning it's very flexible from the standpoint of taxation, and at the same time combine the best features of corporations, meaning that you can bring people together, multiple parties together in a format that allows you to kind of maintain governance and other sort of operating controls. I would say that if in any given month I'm forming 10 new businesses, 9 out of those 10 are limited liability companies, as opposed to any other form. Partnerships are kind of an animal in and of itself. Earlier in the conversation, we talked about private equity. And for the purposes of this discussion, let's just say that private equity funds are oftentimes formed as limited partnership to take advantage of very specific tax benefits that are not going to apply for 99% of your viewers and listeners. For most of your viewers and listeners and the sort of folks that you described at the outset, someone who may be thinking about endeavoring into starting a film project, a streaming service or something of that nature, you're more than likely going to start off as a limited liability company. Over time, those businesses may evolve and scale to such a point that they may want to change its organizational form to be a corporation. That normally happens when you're looking at taking on investment from sophisticated investors who may require that those businesses be set up as what's called a C corporation. And a C corporation is a particular sort of corporation that has dual layers of taxation, but it's also beneficial to certain classes of investors because it allows them to obtain certain tax and other benefits. But for most businesses, that's, years down the road. And I would say that, again, for the purpose of this discussion and for the sort of folks that, you and I are going to be talking to that are going to be consuming this particular program, limited liability company is the most flexible sort of business entity that meets most people's needs.
Okay, that's helpful. Now, tell me this though, is there a fact pattern or a situation wherein you'd recommend to a client not to create the entity, but just have a contractual relationship vis-a-vis a joint venture agreement? Is there a scenario like that?
It's a great question. In my experience, joint ventures, look, when you talk about joint ventures, you could either have a joint venture agreement, which is an agreement by two or more parties to agree to perform a certain set of services, or you could have a joint venture entity in which two parties come together and are actually forming a particular entity to pursue a particular objective. In my experience, and again, I've been doing this at this point for 21 years, joint venture agreements are, fairly easy to paper, incredibly difficult to execute, because ultimately they don't have the same sort of teeth that if the expectations of one party or the other go unrealized, prevents a party from just walking away, and the party who doesn't walk away feeling as though they have recourse against that other party. So my, very, very strong recommendation, if people are thinking about entering into a kind of a joint venture sort of relationship, is to actually form an entity to pursue that, just because of the fact it really gives some teeth to the relationship that's being contemplated, as opposed to just a simple joint venture agreement, which again, in practice and in my experience, are extremely difficult to execute.
Well, let me ask you this. So the scenario where the group of people has already created the joint venture agreement and realizes the practicality of having an LLC, a limited partnership agreement, kind of control and manage, this business enterprise. Does the joint venture agreement then have any relevance after they create the LLC? Meaning, should it be added as an appendage, say, hey, Exhibit A is how we're going to do everything, even though it's like an operating agreement as well? So do the operating agreement of the LLC and the joint venture agreement work together? Do you just get rid of the JV agreement?
Yeah, in my experience and in my practice, what I've done in those circumstances is I'll incorporate the relevant provisions of the joint venture agreement into the limited liability company operating agreement and essentially just kind of rip up the JV agreement. So the things in the joint venture agreement that are working, we'll incorporate those into the limited liability company operating agreement, and the rest of the provisions will essentially sunset those, and the LLC agreement will supersede the JV agreement.
Okay. Now, that's a really good point. I'm glad you pointed out. So now we talked a little bit about the variety of entities and vehicles that could be used to take on an investment, but let's talk a little bit about the resources of the investment, where these investments potentially would be coming from, and what kind of separates them, and why one may be better than another. So, so there are private equity firms, there are venture capital firms, from finance companies, media companies, lending institutions, meaning banks, equity crowdfunding platforms, all very different. But if your client, the investor, has a choice of whether they're going to take money from Comerica Bank, let's say Annapurna Pictures, or some venture capital, let's see, Palm Star Media. How do you advise where to go and who to take money from?
Yeah, I mean, look, it's not a one size fits all analysis. It's really, you have to look at it on a case by case basis and what the client's objectives are, like what they're seeking to accomplish and what's most important to them. Let's take, first of all, let's look at the example of just like a big bank. The benefit of doing something with a big bank, such as a Comerica, for example, is that 9 times out of 10, when they're investing as debt, vis-a-vis some sort of debt instrument. And the benefit of taking on debt, we get into the negative side of taking on debt, but the benefit of taking on debt is that it's non-dilutive, meaning that if I were loaning you $1, if you own 100% of your business at the outset and I loan you $1, you will continue to own 100% of your business. My investment is not dilutive. And so long as you pay me back on the terms that we'd agreed, once I've achieved my return, you and I go our separate ways. You got the money that you needed to grow your business, to scale your business, to operate your business, and I'm no longer involved with your business. We go our separate ways. That's the benefit. Obviously, the downside of taking on debt is you have to be able to ensure or be comfortable that you're going to, in fact, be able to repay that debt. Because if you don't repay the debt, and particularly in the instance of secured loans, such as the type that an institution like Comerica would typically take, I'm going to take security over whatever assets I can get. And if you don't repay the loan, I'm going to essentially be able to attach those assets and liquidate those assets for the purposes of repaying the loan. So that's the pro and the con of taking on debt from an investor such as a commercial bank like a Comerica. When you talk about either private equity or venture capital firms, put those two in a bucket, or a strategic investor, such as you mentioned, Annapurna Pictures, the analysis there really revolves around what sort of strategic value you're going to be able to extract from one sort of investor versus the other. So if you are in the film business, for example, and you're taking on investment from another business that's already in your space, the benefit is that you're going to be able to extract some sort of best practices from them, particularly if they're a larger business. So maybe they'll be able to help with the development process. Maybe they're going to be best practices that they'll implement to your marketing of projects. Maybe they're going to be best practices that you'll be able to extract as it relates to developing a pipeline of projects and doing so efficiently. Or maybe they will allow you to get access to a broader platform for distribution. So you're taking on investment from a business like that because they're going to bring some sort of attributes or qualities to your business that you don't already have. Private equity, on the other hand, are strategic, but oftentimes not in such an obvious way. Because private equity firms oftentimes have a portfolio of a diverse array of businesses, what you're often looking to when you're entering to those sorts of transactions, and again, both private equity and venture capital, is, are there other companies that they're aligned with? Are there other businesses that they're aligned with that are going to help me expand and scale my business? Maybe the principals of the private equity firm have great relationships with the heads of studios or the heads of streaming services that I want to get into business with. Maybe those private equity firms have great relationships overseas. So I want to get my content distributed in China or in other parts of Asia, in Europe and Africa. Maybe they bring those sorts of relationships to bear. Private equity and venture capital firms oftentimes bring less linear sorts of strategic value, and oftentimes more circuitous strategic value, meaning, maybe not be a straight line to get from point A to point B, but because of the overall scope of their relationships and their connectivity across multiple sectors, they're going to help me get from point A to point B a lot more quickly than I would get there myself.
Would you also say that, there's also this element of the, having, let's just take your garden variety, most prestigious, venture capital firm invested in your enterprise. And even if they're not going to help you get another investment through their portfolio, the association in of itself can lend itself to other people, other organizations wanting to invest, because they're like, well, if these guys have their money invested with this organization, then I think our money would be safe too. Is that?
Yeah, I mean, look, I think you're exactly right. What it does, having certain kinds of institutions, such as private equity firms or venture capital firms, on your cap table, and again, for the purposes of the viewers, your cap table is essentially your list of investors. When certain parties see that a Sequoia, Andreessen Horowitz, Vista Equity are investors in your business, that provides a certain amount of credibility that allows you to raise capital from other similarly situated investors.
Now, you didn't mention it, but I want to know too is, what about this new I guess conduit to capital, the equity crowdfunding platforms?
Right.
How serious should entrepreneurs be taking these organizations and platforms as real relevant opportunities and conduits to capital?
Look, I think that the emergence of crowdfunding platforms have, it's been really exciting in the sense that it deepens a level of engagement between businesses, particularly consumer-facing businesses, and the people who are passionate about those businesses. If I am a fan of a particular business, for me to have the opportunity to actually invest in that business and to support their growth and their continued success. From the standpoint of being an investor, I think it's really exciting. And I think also on the other side, from the standpoint of companies that depend upon consumers and fans, as the buyers of their products, to deepen that level of engagement vis-a-vis an investment, I think is really important. I will contrast that level or that category of investment versus the type that we discussed previously, which are, again, private equity firms and venture capital firms on the one hand, and strategic investors in the form of other businesses, larger businesses in your own space. On the other hand, when you're taking on investment vis-a-vis a crowdfunding platform, the only detrimental aspect of that is that you're really not bringing anything else to bear other than money. So there's not necessarily any sort of strategic element or attributes that are going to help to necessarily expedite your growth into areas that you have not already been able to penetrate, because it's just bringing on money. So, similarly speaking, I oftentimes have clients who are looking to raise capital, and they're considering between bringing on money from someone who's already in their space. And again, there's pros and cons, because they're going to add some sort of strategic value, but you're also giving that business kind of a free look under the hood. And, there could be trepidation there versus bringing on money from just a high net worth individual. And oftentimes when you look at taking on money from high net worth individuals. And to a certain extent, I would kind of put these crowdfunding platforms into a similar category. You have to be very sober in your assessment of the fact that bringing on that sort of capital is literally not doing anything for your business other than providing money. Now, look, we all need money to operate businesses. I mean, that's the reality. And oftentimes you're going to take on whatever sort of capital you can raise most easily, most efficiently, most quickly, be able to support the growth of your business. But given the choice between the two, my role as a counselor and an advisor is to help them weigh the pros and cons of each. And going back to your question specifically about these crowdfunding platforms, again, the only moment of pause that oftentimes occurs to me in laying that option out for my clients is the fact that you're not really getting any additional bang for your buck.
That's really valid. I'm glad you pointed it out. So I think it's easy to underestimate the impact of having the right parties aligned with your business through investment versus just having versus access to capital, right?
Yeah.
So
I mean, look, here's the reality. Most businesses that have been highly successful, businesses that go from being startups to becoming businesses that are generating 7 figures, 8 figures, 9 figures of revenue, it takes a village. They oftentimes don't necessarily do it organically just through slow but steady growth, but it takes some sort of an accelerant to be able to take the business to the next level. And in my experience, that accelerant has more often than not involved aligning with some form of a strategic investment from an outside party to take the business to the next level.
Okay, well, speaking of levels and phases and stages of investment, can you walk us through, again, conceptually, contextually, what it means to be at the pre-seed stage, seed stage, right, Series A, Series B? So what do these stages mean, effectively for a business, and how relevant are they when it comes to raising capital? And can you skip them? I mean, how does that work?
Yeah, and look, and I think we touched upon, maybe indirectly, but touched upon some of these earlier on in our discussion. So when people talk about pre-seed, what they're really talking about is the very outset of your business. You're starting a business, you file your paperwork to launch an LLC, to create content. Your business is literally just a piece of paper at that stage, and you're looking to take on that very first investment in order to launch your operations. And that's referred to as kind of pre-seed. And the reason why it's called pre-seed is because the next stage of investment are called seed rounds of investment. And where that comes from is just like when you're planting a tree or you're growing a garden, you plant those seeds, you cultivate the dirt, you water it, and then you just step back and you wait for it to grow. Similarly speaking, the investment at the seed stage are the catalyst for the future growth in those sorts of business, because oftentimes the sorts of investors that are making those sort of seed investments are not necessarily really actively involved in the business. They believe in you as an entrepreneur. They think you have a great concept. They want to provide you with capital to kind of get you on your way, and then they're going to take a step back and see where things grow. Mm-hmm. To the extent those seeds start to grow, the tree starts growing, the grass starts growing, the garden starts blooming, the flowers in the garden start to bloom. That's when you get into the sort of categories when venture capital investors may take an interest in your business. So you may have had a proof of concept, you start executing on that proof of concept and start establishing some sort of traction. And at the point at which you start to look to venture capital firms who are typically investing in businesses that are earlier stage in the sense that they're not yet profitable, more often than not, they're generating revenue, but the amount of revenue they're generating is less than the amount of their expenses, and thus they're not yet profitable. Venture capital firms will get involved, and the first round at which venture capital and similarly oriented investors get involved is considered to be that Series A round of financing. Those investors are taking a minority stake in your business, oftentimes between 5% on the low end to kind of 25 to 30% on the high end of your business. Hopefully not getting any beyond that in terms of the amount of equity that they would be taking on your list of investors or your cap table, as I described earlier. But that series of financing is often a milestone, because at that stage, you've really started to align yourself with very sophisticated, very smart, very well-connected classes of investors. Mm-hmm. And to the extent the monies that you've raised through that Series A round of financing is allocated towards growing your business prudently, in a meaningful way, in a very smart and strategic way, that will then lend itself to subsequent rounds of financing, which, if you had your Series A, you're ultimately going to have your Series B, your Series C, and so forth. Oftentimes, when you have that sort of trajectory, you reach kind of that fork in the road moment where you're either going to, when people think about companies like Facebook, they think about companies like Uber, you think about companies like Instagram, or maybe Instagram's not a great example because it was acquired at a fairly early stage by Facebook, but companies like WeWork and others, you reach this kind of fork in the road moment where you either continue to raise capital from private sources of capital, or you decide that it's time that you go public. So again, taking yourself out of that sphere of taking on private capital and deciding that it's appropriate to now take on public sources of capital. And people talk about an IPO. What that means is you're engaging in an initial public offering in which for the first time, your shares are going to be listed and sold on exchanges in which they're going to be freely tradable, as I mentioned before, such as the New York Stock Exchange or NASDAQ and the rest. So, I think what we've just now laid out is that entire life cycle between starting a business in which you're taking on pre-seed investment to all the way up to the point at which you're undertaking an IPO, in which your investors now become the general public or any parties that may want to kind of buy and sell your shares vis-a-vis a public exchange.
Okay, yeah, it's very comprehensive understanding of that. Now, is there any formula that correlates to the amount of you have the outstanding debt or the outstanding capital raise, the amount of money that the investor is going to invest, and then the equity associated with that investment? Is there any formula correlated to that? Like, so if I'm investing 5% of the outstanding capital I need to raise, it means 5% of that will be equity, or is it really relative?
Again, it's not necessarily a one-size-fits-all analysis. Mm-hmm. But I think what you're really touching upon is what's the valuation at which an investor is investing in your business. Mm-hmm. And, the simplest way of looking at it is if you had a business and you and I'm the investor, you're the business owner, decide that your business is worth $100, just to give a simple example, mm-hmm. and you're only really willing to sell a 10% stake in that business. If I invested $10 in your business that's worth $100, by extension, I would have a 10% stake in your business. Mm-hmm. That's as it relates to equity-oriented investments. Mm-hmm. I think for the purposes of this discussion, it probably doesn't make a lot of sense to get too granular into different vehicles such as mezzanine financing or, convertible debt, meaning I may be investing in your business through some sort of debt instrument, but upon the occurrence of certain conditions, I can convert that debt into equity. I think that's, that'll be the next time we get together.
Right.
We can talk about that.
Yeah.
But the simplest way of looking at it is, when someone invests in your business, you and that person are going to have to agree as to how much your business is worth, and then what my proportionate share in that business will be once I make the investment.
That makes a lot of sense. Okay. Yeah, no, thank you for that. Now, let me ask you this, pivoting a little bit into, again, being strategic about how you manage, or an entrepreneur manages an investor relationship as well as an investment.
Right.
So know that, well, you know this, and we'll make this, you can maybe expound on this for the audience. So in the event that an investor is taking on an investment, an entrepreneur is taking on an investment, and the investor is considered to be a passive investor,
right,
that's going to trigger certain federal securities laws that they have to, manage. However, if that investor ends up being passive, then they won't. The entrepreneur will not have to register the investment as a security. Won't have to comply with the tons of regulations and stuff like that. So my question to you is this: is there, for those entrepreneurs that want to be cost conscious and try to ride the fence with this a little bit, and they know that the investor probably won't be very active in the business, but in reality they may be a little bit active, so they want to classify them as active, but they may be really passive. Basically, what I'm ultimately saying, and I'm not trying to suggest you give us ways to circumvent, securities laws. I guess what I'm really saying is, on a practical level, what can entrepreneurs do to manage that obligation to register their investments as securities, because it's going to be very expensive and complicated?
Yeah, look, well, here's the thing, and I'll clarify part of what you said for the purpose or for the benefit of those folks listening. Technically speaking, any transaction that involves the sale of securities falls under the purview of the Securities and Exchange Commission, and specifically the 33 Act and the 34 Act, which regulates the sales of securities. Again, don't want to get too granular for the purposes of this discussion, but I think what you're really pointing to are, in what instances do you have to register versus those instances in which you don't. And it really boils down to, in those instances in which you don't have to register, it means that you qualify for an exemption from registration of those securities. So it's not that they're not subject to the regulatory oversight of those regulatory bodies, such as the SEC. But really what it boils down to is the particular transaction that you're engaging in qualifies for exemption from registration. And the simplest way of characterizing it, it relates to the transferability of those securities. So as we talked about before, you have an entire regime of private transactions, and then you have a regime such as the one that I discussed when you undertake an IPO, in which you have a public realm in terms of the sales of securities. To the extent you're engaging in a transaction to sell securities that are not freely tradable, that there's not really a public market for those shares, you're not marketing widely, engaging in publicity, hiring firms to do investor relations or marketing to sell your securities, but it's just a private transaction between, amongst a very narrow universe of folks. And upon the sale of those securities, the securities that were the subject of the transaction are not going to be widely marketed for resale. Generally speaking, those transactions qualify for the relevant exemptions from registration. Where people can get themselves into trouble, and if you read the Wall Street Journal, you look at Bloomberg, you'll see from time to time, you'll have companies, some of these companies that are on a pre-IPO trajectory that you'll see. I think this happened quite a bit with Facebook before Facebook went public. There was such a fervor for Facebook shares, and there was so much excitement around the prospect of Facebook eventually going public, what you saw was that people who had Facebook shares, whether they were investors in Facebook, whether they were employees who had access to shares on a pre-IPO basis, almost kind of creating kind of a shadow public market for a private security. And companies can get themselves in trouble in those instances in which people are freely buying and selling shares of private securities. That's a recipe for disaster from the standpoint of, you know, not just having the SEC coming in and slapping you on the wrist, but really exposing yourself to, you know, both civil and criminal penalties. So long as, you know, 90% of the sorts of transactions that you and I have been discussing during this dialogue, which just involve, I need to raise some capital to expand the scope and the scale of my operations. In exchange for the money that you're providing me, I will sell you a stake in that business. You're going to be locked into that stake until such time as we decide to sell the business, until such time as I buy you out of that stake, or until such time as we engage in a transaction with an extremely limited universe of potential investors, one of whom you may sell your shares to. Those sorts of transactions are fine, will oftentimes fall well within the comfortable confines and the framework of the exemptions from registration. But instances in which people are kind of freely trading private shares as if they were listed on the New York Stock Exchange, are going to get you into trouble 10 times out of 10.
Okay. No, thanks for clarifying that. And just to point out one other scenario, we want to make sure it fits into what we talked about in terms of what will be exempt. If A24 said that, hey, you know what, I love your film idea. You know, here is we're going to create this LLC to launch this film project that you wrote the script for, and they're going to fund it, and you know, I'm gonna produce it. That is an investment, but a scenario like that would not require any kind of registration of a security interest.
A transaction like the one that you described would qualify for an exemption from registration.
Yeah, that's what I would imagine.
Meaning, again, technically speaking, it falls under the regulatory regime established under the 1933 Act and the 1934 Act. However, due to the nature and the quality of the transaction, the specifics of the sort of transaction you described, you would be exempt from registration.
And just for the audience, what is that exemption called, so they know what that is? There a general, you know, is there a statute number? Is there a rubric? What would you call that exemption?
I mean, look, I think people just refer to it as a registration exemption. Okay. I mean, you know, I think, again, for the purposes of the viewers and the listeners, unless they, you know, want to kind of we could have a separate section in which we could go chapter and verse through the 33 Act and the 34 Act. Yeah. But people, you know, can feel comfortable and confident in knowing that so long as people are not freely trading, freely engaging in the buying and selling of the equity in their business with third parties, that they're going to be exempt from registration.
Okay, fair enough. Thank you for explaining that. So we're coming to the tail end of our conversation here. I know you got a lot of work to take care of.
I've enjoyed it. Hey, I'm here all day.
Yeah, but we want to make sure this is COVID-19 era. You know what I mean? All kind of crazy. You got to teach classes with the kids. You got to
exactly
Zoom calls. So let me ask you this. Actually, we'll skip over that. But let me ask. We've been talking a lot about taking on investment, managing investments. Is there a general budget range that an entrepreneur should be prepared to be prepared for when it comes to paying for the legal advice, the accounting consultations, all of the elements that come into taking on an investment for a business? I'm sure the budget range obviously is going to be tied to how much money the investment is reflected in the investment, but is there a general rule of thumb that you'd recommend for a budget for something like this to manage?
Well, I mean, look, not to kind of deflect your inquiry or your question. But
Yeah.
I think one of the things that you said a moment ago is really the most important thing. With it honestly really depends on how much capital is required to be raised, because the more capital you're looking to raise, by extension, the more complicated those sorts of transactions oftentimes become. It often depends on whether or not you're going to be soliciting investment from one investor or 10 investors.
Yes.
It oftentimes depends upon, whether it's just a straightforward equity transaction like the sort we described, or some sort of a hybrid transaction like the one that I said we weren't going to get into in this particular discussion. So it honestly really depends on a number of variables. But what I can say, and you didn't ask this, but I'm going to offer it up anyway. What it really speaks to is something I talked about before, which is having your house in order before such time as you go out seeking investment. Because one of the things that any investor, when they're doing due diligence or considering making an investment in your business, is going to want to see is that you spent the time to put together an operating budget for your business, an operating budget that contemplates how much money you need to run the business, how long, once you've raised that amount of capital, how long that's going to last, and similarly speaking, how much you've actually budgeted for services such as third-party legal, for accounting, for consulting, and all those sorts of things. So again, while it's certainly not a one-size-fits-all analysis, I think it's invaluable for people in that position to actually spend the time and energy to put together a budget and to make projections, and kind of baked into that budgeting process is going to be a budget for legal and accounting. And look, I can tell you that from my standpoint, the first thing that I do when I'm sitting with a prospective new client is to ask them how much they've budgeted for legal. First of all, because you don't want to create any sort of uncomfortable tension with a prospective client, or have any sort of sticker shock as it relates to the services that you're rendering. But I also want to make sure that they've taken the time to really carefully consider how much money they have to allocate to third-party service providers, and whether or not they've incorporated those considerations into the overall capital requirements for the business.
Okay, really good. Yeah, really important. Because if they don't have, the budget to manage just the expertise they need to conduct this transaction, then they're really not ready to be in this transaction. So
more likely, more often than not, that proves out to be the case.
Yeah, that's a great litmus test. So tell us this: is there anything on the horizon, or anything that you're seeing present day in capital markets and the entertainment space, as it relates to finance, as it relates to investments, that people should be mindful of, aware of? I mean, one of the things that I was going to ask you about was this new, kind of capital, which is through cryptocurrencies as a means of raising capital for businesses. Yeah. Is there anything like that you're kind of tracking and paying attention to?
Look, I'll be honest with you. In light of this COVID crisis and the impact that it's had across the board, I really feel like it's back to basics. A year, 18 months ago, we were seeing, blockchain, cryptocurrency sorts of investment opportunities, transactional opportunities coming across our plate, once or twice a day. I can tell you, I haven't seen one of those sorts of transactions in the past 3 months. Wow. I think it's really back to basics. And I think what it really speaks to is that in an environment such as the one that we're in, cash is king. Cash is good old fashioned, cash is king. And those folks who have access to capital and who are nimble and quick in terms of deploying that capital are in a really, really strong position to do the sorts of deals they weren't able to do 3 months ago. What I would say from my lens, and when we started this conversation, I mentioned that, for my part, and I speak both for myself, but also for our firm, we've been extremely busy. There's a very, very robust marketplace, notwithstanding the disruption in the economy. There's a lot of capital that had been raised in 2017, 2018, that was literally sitting on the sidelines. They felt that businesses were overvalued. They felt like the market was overheated, and they weren't looking to invest or deploy capital at the top of the market. So they were waiting for things to cool off. I don't think anybody could have plausibly suggested that they anticipated that what's happened over the course of the last 3 months would happen. No one could have possibly seen this coming. But I think people did have a sense for the fact that the market was going to cool down somewhat, and that all of that capital that had been raised in 2017 and 2018 was going to flow back into the market once things did in fact cool off. And so we're seeing a tremendous amount of activity from people who have a lot of capital, looking to be very strategic, looking to be very opportunistic, invest in solid companies with solid management and great business plans. Again, companies that have their house in order. And so the reassuring thing, I think, from the standpoint of our clients who are looking to take on investment, there's no shortage of capital out there to invest into their businesses.
Great. Yeah, that's good. That's reassuring, I'm sure, for a lot of entrepreneurs looking for capital. So are there, because it sounds like you're tracking, you stay abreast of what's happening in the marketplace and you track what's happening. Are there any resources, websites that you'd recommend that lay people should use to do the same thing, or resources that they can use to kind of read up, prime themselves on some of these more sophisticated transactions?
Yeah, I mean, look, I'll say this much. My lens is maybe a little bit different. As I said before, my practice, even within our own firm, is different because I'm less pure talent oriented and more corporate transactional oriented. But with that being said, I read Forbes every day. I read the Wall Street Journal every day. Because of what I do, I tend to focus more on the stories that they're covering in the media, entertainment, and the technology sectors. But with that being said, I'm on Forbes.com every day. First thing I do when I wake up in the morning is I'm on WallStreetJournal.com and just kind of looking at what's happening, the ebb and flow of transactions in the entertainment and media sector. And, I'd say over the course of the last 4 to 5 years, their coverage of entertainment, media, technology, kind of the convergence of all of those areas, often the factor that binds all those areas together is just content generally. Their coverage has really improved a great deal. And I would, really strongly recommend for anybody that was interested in kind of figuring out how finance intersects with content, media, entertainment, sports, don't sleep on Forbes and Wall Street Journal. They have really, really good coverage.
That's great. So we're about to close out. So, there's a lot of activity. There was a ton of activity in the entertainment space when it came to acquisitions, a lot of mergers. AT&T, Time Warner, AT&T just, I think they're raising like $30 million in debt, or maybe even more than that recently. I read in Deadline today. And who knows what's going to happen with Quibi, and you have Disney that's absorbed most of, if not all, of Fox's assets. Do you have your own prognosis for the future in our content space, or any anecdotal stories from client consultations, things you've observed that would be, and somehow would illuminate, our listeners and viewers about the world of corporate finance and entertainment?
Look, I'm going to answer the questions really through the lens of content because, much in the same way I mentioned a few minutes ago, cash is king. In terms of media entertainment, content is king. And, there are, from a distribution standpoint, the manner in which content creators can get that content in the hands of content consumers without the middleman, without the traditional kind of distributor who serves as the intermediary between the content creator and the content consumer. We've seen such a tremendous proliferation of that. Obviously, Netflix changed the game in that regard. A lot of the traditional media companies have spent billions of dollars investing in the resources and infrastructure to be able to do the same, whether you're talking about Disney Plus, HBO Go, the Peacock app. You're just going to see more and more of that. Mm-hmm. And I would say over the course of the next 2 to 3 to 5 years, what I anticipate is that all of the major players are going to throw their hat into that particular ring. They're going to put their content offerings out into the marketplace, and invariably, as we've seen with more traditional means of content being consumed, you're going to see consolidation. There's going to be winners and there's going to be losers. Mm-hmm. As to who those winners and losers are, remains to be seen. But maybe the last thing I'll say on this particular subject, and something that really, really resonated with me, was I've recently read Bob Iger's book, mm-hmm. Ride a Lifetime, which for those who haven't read it, it's an incredible book. It's a great story. It's a very quick read. Read it over the course of a weekend, and it's super insightful. But one of the things that Iger described was the genesis of the Fox acquisition, how that came to pass. And in discussing that, or in laying that out, one of the things he mentioned was, as big as Fox was, the assets that they sold, the 20th Century Fox studio, the local cable affiliates, the sports affiliates, the one thing that they felt they didn't have relative to Netflix was scale. They didn't have the scale to compete, which, when you take a step back and think about that, it's pretty sobering. Business that was generating billions of dollars a year in revenue, that had an expansive reach and network, on the local level and also on a national level, felt that they had to get out the game because they didn't have the scale to compete with Netflix. And by extension, the fact that Disney felt comfortable absorbing someone like Fox, or a company like Fox, because they felt like they did in fact have the scale to go one-on-one with Netflix for the long term. Things to be really interesting. I think the next several years, again, we may all have these bundles where we have 5 to 10 different little streaming services, but it's going to kind of consolidate and go right back to the stage where you may have 1 or 2.
That's what
in 5 years.
Yeah. No, I agree with you. I mean, I agree with kind of your description of what the future looks like. I think 5 years, 10 years, whatever it is, I think we'll all be looking at one channel that has everything we want to see. Owned by one media company, you know what I mean? And one tower with one big antenna, so.
Exactly right.
But it's going to be quite an interesting future. But I'm going to check his book out, though. I used to work for it.
Yeah, it's a great read.
Yeah, I'm going to do that. Listen, Corey Martin, appreciate you being part of the Brooklyn Boardroom. This conversation was extremely, extremely productive, I think, for the listeners and viewers. And I think you give us a lot to digest and build on. So appreciate you taking the time, brother. And I'm looking forward to staying in contact and communicating more of these things and bringing you back at some point.
Absolutely. Now, I would love to come back. Thank you for having me on. And, both for you, your family, and everyone that's going to see this, I just hope, first and foremost, everyone stays healthy and safe.
Yeah, man. And give your wife kudos for the great plant, the great work she's doing back there. Gardening.
Yeah, I can't take any credit. I can't take any credit for this. She just told me, sit here, look into the camera.
Everything looks healthy. You're doing the right thing. You know what I mean?
Right.